Good
Welcome to the
stuff.
presentation. My name is Kevin. We'll be talking about raise phases and strategies, how much to ask for, what cap tables mean, and other knickknacks that kind of surround raising money in general. Okay, again, my name is Kevin. I've been through, let's say, two rounds so far. And so I'll be speaking a little bit from experience as well as through knowledge from what other mentors have given to me. And so I'm sharing it now with everybody else. So we're going to start with the founder and investor journey because again, the founder and investor, they're both partners in this endeavor, right? They're both balanced in this endeavor and everybody wants each other to succeed. And so the first round that you'll be looking at, the first phase of funding will be likely looking at is called the angel round, right? And a lot of times this is your idea stage. You know, a lot of times we'll talk about this. I'm going to speak about this in a lot of generality here because a lot of these scenarios will kind of mesh together into each other. But generally speaking, the angel round will be your idea stage. You're a lot of times pre-revenue. You've got an idea, you don't have an MVP yet. Maybe you have an MVP and you're trying to scale it, but you just don't really know how to start. In this round, the investors that speak to you are going to be investing in you. Definitely the idea, but definitely investing in you because a great idea with no execution is going to be a bad idea, right? And so when companies look at you, when investors look at you, when your friends and family look at you, they're going to ask, "Hey, do I believe in this person? And do I want to put my money into this person?" With the knowledge that a lot of times these things don't work out, and so your raise is going to look like around 25 to $500,000. And I know that span is very large, guys, and it really comes down to the industry itself, what you're raising funding for, what your goals are, what do you want the money for, right? And what the end aspiration is. So it will differ from industry to industry. It will differ from the goals that you're setting for that round. And it will differ for definitely like if you're looking to create technology or you're looking to create a product. And this presentation will kind of cover both, right? But just keep in mind that a lot of these are generalities here. That's why there's so much space in there and a wiggle room in there. And after your angel round, you've found your product fit. And by product fit, we mean you're revenue generating. That means that people out there in the wild have looked at your product or service and said that, you know what, I want to pay money for this, or I want to use this product for me. And generally speaking, that's when we say you have found your product fit. Not all the time, though. A lot of times you could be revenue generating and raising an angel round because you haven't found your perfect fit. You found some sort of a fit. You know that this plug goes into this round peg, but you don't exactly know how yet. But this is also when you start talking to your customers a lot and saying, "Hey, why did you sign up for me? And why are you giving money? Why do you believe in this company?" A lot of times, what you'll see is that these two rounds can kind of meld together and mesh together, but you are generally going to be revenue generating from $100,000 to a million or over a million. What I've experienced in this space, at least in North America, is that the ARR expectations have started to trend upwards because of the market itself. Money is a little harder to find nowadays, but money is definitely out there. And a lot of the money that you'll find in the seed round are going to be from funds. The VCs are representing funds, and the funds are representing their LPs, limited partners, right? What this means, and a lot of times I'm going to go back to a refresher of what all these phrases mean, is that the LPs mean that they've invested into this pile of money, and the VC controls that money and is vetting what opportunities they're going to put their money into. And what they expect is they're going to expect at least a 10x return on their money. And what they want is for you to get to a Series A in 1 to 2 years, and they're looking for you to raise $500,000 to $3 million in the seed round. Again, that chasm is giant, and it really depends on the goals and the aspirations of the company itself and where the investors see that they can add value or where they see they can hit the next step, which is the venture round. And that's when they see rapid scale. And we call that the hockey stick effect, right? Is when you look at a company, you look at the revenue or the user base, or their customer, whatever measurement you're using, and all of a sudden they see this. And I use a little rocket ship up here. And the reason why I use a rocket ship is because they've got the fuel, which is money, and they want to fuel the fire. That's what they want, right? So you want to prove to them, hey, I have hit the hockey stick, and I now need your money to make a ton of money. To generate a ton of return on their investment, right? And again, generally speaking, you're going to be looking at an ARR of over $1 million, or you're scaling quickly. That's key here. This looks linear, but it may not be. You can go from angel and all of a sudden hit a hockey stick in the angel round and go to venture. You can go from angel to seed, or sometimes in an unfortunate setting, you may go from seed back to angel, right? Because if you might need a bridge round, remember this as well. I wanted you to remember this. You can repeat your rounds. If you raised an angel round and all of a sudden you've hit what the angel round needs you to hit, and you want to raise another angel round, you can do so, right? Really depends on the amount of money that you want to raise. Okay, I'm going to pause there really quick and open up for just quick questions. Anything on this slide here? Yep.
Kevin, yeah, Kevin, I have and just a reminder to everyone who's not Kevin, if you would, Scott, can you mute your mic? Scott, mute your mic, please. Everybody who's not Kevin, if you would, please mute your mic. Thank you. Kevin, so I've heard of Series A, B, C. How does that fit into all this?
So a Series A, a Series B, a Series C, where you're looking now, generally speaking, is going to be what you're looking at the venture round area here, right? The reason why I didn't use those terminology at this point in time, because they can be fluid, but a Series A round generally can be a price round. And we're going to go through those topics later on. A Series A round is generally seen as a price round where you don't have a valuation cap anymore. You're looking at a price round where they value the company. You go through the valuation, you go through lawyers, you value the company at a certain amount of money, and that's what they're putting the money at. And that's when all your previous investors get all really giddy and happy, and they've received a return on their investment. Because when an investor receives a safe note, and we're going to go through these terms right in the next slide, but when they receive a safe note and a convertible note, you technically still own your entire company 100%. That cap table is showing that you have liabilities, you owe people certain things, but you still own all the shares, right? Have I explained that properly, by the way, Ben? Because I haven't gone through the Series A round yet, but as a general aspect.
Yeah, I think I think that's, I mean, that jives with my understanding. And like safe note, for example, yeah, you still own 100%, because they're not actually on the cap table yet. There's a commitment to bring them onto the cap table at later rounds. And I'll let you get to discounts and caps and all of that stuff at your own, whatever pace you prefer.
Of course, yes. Anybody have any other questions about these steps in this kind of investor and founder journey at this point in time?
Yeah, I do really quick. How many
Mhm.
series? How many series are there? Like, how many series can you go through? You
Can
have
or
A,
are
B, C.
there?
Is there more?
Yes.
Yeah, and I mean, I
Yeah,
don't
they can go
know.
from A, B, C, D, E even, right? But after E, you're looking at an IPO at that point. But you can go through multiple rounds. And the letters, to my knowledge, are very arbitrary in that manner, because you've heard of series, like I've heard of Series E rounds, and so forth, but they're really just to denote a progression of the valuation and the amount of money being put into a company. Um, and so and that's when you actually get to what we see here: growth equity and private equity. And we won't really cover this in this, just because we're really focusing on the angel seeded venture, or else this presentation can go on for a long time. And I'm going to be glossing over a lot of, we'll say, more advanced strategies in that case, just because I want to kind of get through where most of us are at this point in time. But definitely good question.
Thanks.
Thank you. Anybody else? Gotta see if there's any hands up. No? Okay. In that case, we'll go through.
My hand. My hand is up.
Andrew's up.
Andrew.
Yeah, I'm just curious. Realistically, who gets money at the idea stage? People who've already had multiple exits.
Can
I mean,
be.
if you're a nobody and you're like, hey, I got this idea and I have a proof of concept. I mean, honestly, it seems like if you haven't had exits, you're not going to get any money. Is that the case?
No, not necessarily true. It really depends on what the idea is and the execution and what you can sorry, what you can tell the investor and things that you can say to back up your claim. And what we'll do is we're actually going to go through a sample of how much to ask for, how to ask for it, and what things that you want to put inside a pitch deck to kind of tell the investor, hey guys, I understand this is just the idea, but there's a lot of little things that you can place within the pitch deck itself to prove that you know your space. That's the really key here. You've got to know your space. The investor is trusting you to know your space far better than they know their space, right? And to prove to them that because you know what you're talking about, you know the holes of an industry or a service or a product, and you can service that. And how can you prove that to them is by doing a ton of research on that space itself and to prove the hole in that industry. So I definitely would not say that not many people raise in the idea phase. In fact, I raised in the idea phase, right? And to kind of give you the background on this is my family came from a long lineage of firework families where we grew up in China. We grew up with a lot of firework background. And when I came to an Atlanta syndicate and group to raise money, what I said was I led with that. I said, look, guys, I have really no startup experience, but what I do have is exceedingly large amounts of industry knowledge. And this is the space I feel that there is a hole in and we can make money in. And that's how I get that conversation started. So I definitely would not say that it's hard to raise, not hard, it's impossible to raise in an idea phase just because I am one that raised at the idea phase.
Great, thanks.
No problem. Anybody else with their hand? And we will move on to the short
Kevin,
terms
actually,
refresh. Yep.
Kevin, I have one more thing on Andrew. So on your question about the idea phase, one other thing to remember, and we've touched on this before in our webinars, is that there's a lot of stuff in between idea phase and making money. Some people feel like, well, if I haven't made any money, if I need to have my MVP to make money, I'm just never going to get investment because I can't make money without getting the app developed or whatever it is. But I can't make revenue and I can't get investment until I've made revenue. So I'm just host. There's all kinds of traction. If you ask ChatGPT, I won't go through the list right now, but if you ask ChatGPT, what kind of traction can a startup show other than revenue? And it'll give you a list of 15 different items. And if you ask it to order that list, it'll give you a bunch of help in terms of ways you can demonstrate traction short of revenue. Kevin, were you about to say something?
So I actually spoke to a member of the founders group who was asking for a little bit of just advice on their application. It was a medical application that they wanted to. They were talking about how in their country it's very difficult to get it's very difficult to get an appointment with a doctor, even though you're willing to pay. So there's a gap in that market. And what they were looking for funding for was, hey, I want to develop an application immediately, right? To build this, and then I can show it to doctors. And I said, why don't you do this? Why don't you go to doctors and say, would you like this app to be built? Just put your foot on the ground, walk to all the doctor's offices in the next like 50-mile radius. We don't walk to them, drive to them, right? And ask them, if I had this app, would you pay for it? And then ask now the next 100 people you meet on the street, would you pay to have access to an app that gets you doctors appointments, right? And if both of these get an overwhelming yes, guess what? You put it in a pitch deck and you say, I want to raise money for this product because I have this validation from what I've received from the street. And that's one really good way to show, hey, you've done your homework. You've shown that there is a need, right? And you need to now raise funding to meet that need. Would that be like an accurate description of one way to show traction in that case? Yeah. Yeah, that's how I would have done it, and that's how I would show it on a pitch deck as well. Does it make sense, everybody? A lot of times people always come and go, I want money to build a product, and the first question was, why do you know the product is needed? Well, don't think, find the data, show the data, and then you'll get money. Data. It's always about data. So short-term refresher on was going to set the stage right now, what a safe note means, what a convertible note means, what a term sheet means. And all this really means is, what is the investor going to receive for the amount of money that they're going to put into the company? Safe notes and convertible notes are types of term sheets because they have terms on it, right? That will then allow them to receive something for the money that they're putting in. Now I'm going to give a sample safe note here. This certifies that in exchange for a payment, the payment by the investor's name or a VC or a company or whatever it is of X amount of dollars, the purchase amount on or about the date of a safe. I should have taken out the name of my company, sorry. Nickel Pay, a Delaware corporation, issued the investors the right to certain shares of a company's capital stock subject to the terms described below. A post-money valuation cap of $3.5 million, and the discount rate of 80%, which is a 20% discount. I actually raised money on this exact note. Okay, so put a lot of stuff on this thing over here. What is a post-money valuation cap? This is the agreed upon term of this safe note that the investor is going to put money in. That is the maximum your company is going to be valued at, right? During the terms of a company sale or a conversion. Does that make sense to everyone? Actually, I shouldn't ask that because then everyone's going to say silent and go, yes. Anybody have questions on what I just said? Okay, so I'll give an example of this. If your safe note does not require you to have both of these terms, but these two terms are the most common terms that a safe note is going to have: a post-money valuation cap and a discount rate, right? Do not do a pre-money valuation. Post-money valuation cap of X amount of dollars. This means that if somebody has put in $100,000 at the $3.5 million mark, and you sell the company for $7 million, in a very simple term, that investor's money has now doubled. Very simple. There's a lot of stuff about dilution and stuff like that I'm skimming right over, but in a very simple term, that investor's money has now doubled. Is there any confusion there right now? Okay. Silence. I like eek at silence just because when I do presentations, silence just kills me. But yes. Okay. Yes. Please ask the question, Xavier.
Okay, so I just have one question, right?
Mm-hmm.
I think this is my first time seeing a safe note, and I'm wondering, are they actually this simple looking, or is this like a summary? Because I always imagined investment documents would be like a whole lot more than this.
Okay. Excellent kind of like observation. So what does SAFE stand for? It means simple agreement for future equity, the whole purpose. And correct me if I'm wrong, Ben, I think the SAFE note was designed by Y Combinator, right? Yeah, it was designed by Y Combinator to speed up the process of investment, right? So literally speaking, the SAFE note is meant to be super simple because it's a simple agreement. They just said, I am going, yeah, there are templates of the one-page safe note. In fact, after this presentation, I've already posted this presentation inside the Discord. You can actually click on this to look at the Y Combinator document. And that is actually where I got my safe note from. Yes, Ben.
Just so everybody knows, some investors will express discomfort with a safe note. I know one particular angel network that says they like to say safe notes are kind of falling out of favor. That's not true. It's just that some investors don't really like them. Now, I personally will not invest in an uncapped safe note, but Kevin will he's talking a little bit about caps and discounts and so forth. And that's a very important feature of the safe note in my opinion. But if anybody tells you, yeah, nobody's really doing safe notes anymore, they're just wrong. Plenty of people are doing safe notes. In fact, I would say it is one of the most popular early investment vehicles.
Yes, and the whole reason is for speed, right? You don't want to bog down the investment time with all these terms. That being said, though, my safe note to protect more sophisticated investors in this had a maturity date, as well as a clause inside the safe note that said if I raise more than $500,000, right, outside of this safe note, that this safe note would automatically mature. What it means when a safe note matures is that the investor, right, will receive shares, capital stock in the company at a certain time and date. Yes, Ray?
Yeah. How many shares, given these numbers? Yeah, that would be my question, but I don't think it's there from what I'm reading right now.
Correct. So in your formation documents, and I'm speaking about the US only for now because that's what I've experienced in, but generally speaking, inside the formation documents of a company, what I've seen the most common is 10 million shares inside your company formation documents, right? So with 10 million shares, you will then be issuing after the conversion, right, an X amount of those shares to that investor at a certain price.
Right. So I take it that this is something that you do with angels, right? I don't know if investors are really like um, it was just
It
said. Is it preferable with angel investors or what?
is very rare to see an angel investor come to you and request a price round. And the reasoning is because, generally speaking, a price round requires a lot of due diligence, right, to properly price and value the company. And that's why these safe notes exist. A price round will most likely happen during a Series A round or sometimes a large seed round. It really depends on the venture capitalist at that point in time. But very commonly, what we look for is also remember you're not powerless in this situation. If an investor comes to you and says, "I'll invest $100,000, but I want it to be a price round," that's a lot of work. You have to properly value the company. There are covenants that you have to add in there, etc. So you may opt to not do that, right? Depends on how needy you are, and we'll go through the kind of the cap table strategies and the raising strategies that you will want to have during that period of time. But the most common method of investment will be a cap, safe, or convertible note. Okay. Have I answered
Oh,
your question?
yeah. So to make it clear, I would go with a save to angel investor, not to any series, because I think it's more appropriate, I guess, at this stage. And then
100%.
yeah,
Yeah.
and then issuing shares would be at the time that is converted, right, and not before.
Correct. Yes. And a lot of times what you'll see is if you hit a Series A round where there is a price round, you'll actually price in the cost of the lawyers and the legal fees and the work required to properly value the company inside the round itself.
Right. All right.
So,
Thanks.
yep. Any questions? Any other questions so far? So we'll move on to the discount rate then. What does the discount rate mean? I hesitate to say this because you generally don't want to be using a discount rate, though you commonly put it inside inside the note. And what a discount rate means is that if for any reason the conversion or the sale of a company does not hit the valuation cap, then the investor themselves get a 20% discount on the sale. So what this will technically mean is they will get 20% more of the sale, like sold rate of the company based on their investment. I know I said a lot of words there, and I think I might have jumbled some of those up, but is there any questions there? And the reason, okay, so and the reason why most companies, most people will not invest in an uncapped convertible or safe note is because there's not a lot of upside to the investor for putting their money at risk at that point in time in you. If all of a sudden you want to raise say they invest in you and there's an uncapped safe note, all they're really getting is 20% discount on the round that you're raising, and there's no cap to it, right? And so it's not unheard of. Uncapped safe notes are done if your company has an obscene amount of leverage on the on the uh, on the raise, and everybody's clamoring to get in the raise, and you're like, you know what, I'll accept your money on an uncapped safe note. And that's really the only time I've seen that. But Ben.
Yeah, the reason, and as an investor, I'm sure there's a situation where I would invest in an uncapped safe note, but my policy is generally not to.
Mm-hmm.
And it's yeah, and the reason is you already are getting a huge benefit from a safe note as a founder because you get to delay your valuation. You get to value this money as though you were taking it on years in the future. So it's kind of like getting an interest-free loan on investment terms. So
Mm-hmm.
it does simplify life for the investor because they don't have to argue with you about your valuation, and it just helps everybody agree. All right, this is like I'm going to put this money in, and we'll agree to do the valuation later. The cap is the protection for the investor, which is why you're like, as a founder, you might be like, well, why wouldn't you do it? An uncapped save note sounds great. Yeah, of course it does to you, the founder. To the investor, it's like, wait, so I'm putting my money in, and if you're at 100 million cap, in 5 years, and I invested $10,000. Well, congratulations to me. I own 1/10,000th of your company, which was an awesome investment choice for me, and I benefit none from it. So the cap is there to protect the investor. Discounts are there to protect the investor as well, but most of them will find the cap more important because what they'd love is if the company is worth 6 times or 10 times the cap in 5 years, and they get a huge premium on their money as soon as the valuation locks.
Yep. And I want to also bring up a topic that is I'll get right to you, Xavier. A topic that was brought up during one of my other meetings in the past with other founders. Is there a scenario of which an investor invests and never converts? Yes. If you don't put a maturity date on the safe note, or there are no provisions in the safe note that say that if you go X amount of money or X amount of time over a certain period or money value, right? That you don't have to convert. I have seen companies out there that do not convert their safe note holders, right? And this means if you've raised your angel round and you never need money again, and you never need money again, and just keep running the company, right? That has happened in the past. It's not good. You'll never raise funding ever again from any other company you start, right? Because you've just burned all your investors. But that goes to show that there are certain levers inside these term sheets that you can mess around with to make sure that the playing field is even. Xavier, you had your hand up.
Yeah, I asked you this once before, but just asking for other people's sake. Right now, I'm still trying to understand how investors are likely to invest in the situation where, let's say, someone is investing 25,000. I don't want to say 50, $25,000, and let's say depending on how fast growing your startup is, put the valuation cap of, let's say, $3 million. When it converts, doesn't that equate to way, I think, less than 1% of the company? In this case, would we investors see it like something profitable? I know, yes, the value may be probably 4 or 5x what they invested, right? But then the whole thought of, oh, I invested, I only own less than 1% of this company. I don't know. Is this something that investors will be fine with?
It depends on the investor. It really depends on the investor, right? We'll go through later on in the presentation the balances between percentages that you want to retain and the investor percentages as well, and those strategies there. But a lot of times the investor themselves, if they're sophisticated, will look at that. If you're at the angel round, they're investing in you. Really what they're looking at is my person that I trust and I believe will do big things. I just asked me for $5,000, right? And it is going to be a bonus if I make a lot of money on this, but I just want to support them. That's a lot of times what you see it do in the angel round themselves. Does that I'll give you I'll give you a case in point. Again, with me, I've had and I'm very lucky to have this, by the way. I am not unaware that this is very lucky, but I've had friends and family that say, Kevin, whatever you build, I will invest in, as long as you give me the opportunity to do so. Because I believe in you as a person. I believe you're going to do big things. And so that is the type of investor you're looking for at the angel round, right? So and that was and now, I mean, now you're kind of indebted to them because you literally are indebted to them as a company. But you also just understand that people have trusted you with capital, and you want to make sure you deliver on that promise. I'll quickly cover the convertible note section of it, which is the extra piece of this interest, right? Is a very, very big core component of the convertible note. And the convertible note just adds a section of interest, which is the money that they've invested in, because it's a loan, accrues interest. And usually speaking, that interest on that convertible note can be chosen to convert into shares or pay out as dollar figure when the conversion happens. Right, and that's a key component of the convertible note. Okay. I'm going to pause there, and I'm also going to move on to our examples, which I think the example is going to answer a lot of questions as they come up. So, how much do you want to raise? Right, this is part of the raise phase, is just figuring out how much you really want to raise. So, we've got a really cool company here, and you've got an idea, or you've got a prototype, or you have an MVP. Really, your prototype can be an MVP, so I'm going to stop putting those two together. So you've got this idea, you've got this MVP that you want to sell. Well, you want to remember what the goal of the company is, right? And if the goal of the company is to raise funds, you're not going to raise it. As simple as that. If the goal of the company is to raise funding, you're not going to raise it because your focus is in the wrong place. The focus of the company should be to solve a problem. And the money is there to help you solve that problem. What will it take for you to solve this problem? Do you need an MVP, or do you need validation of the MVP? How much do you need now to get to whatever goal you have set for yourself? So maybe the cost of the MVP or the cost of the validation itself. And don't forget that you are part of the cost of that validation or MVP, right? And you have to be aware that you can raise too little or too much. I personally tend to try to raise more than I think I need. And the reasoning is because if you have investor interest at this point in time, you want to take advantage of the investor interest and raise an appropriate amount of money to reach that goal, or combine goals and reach it, right? So if you're at the I want to solve a problem and I want to build an MVP, but I have a lot of interest because I've set up my presentation very well, why not budget out what you need for the MVP as well as validation? And validation can be many things. It could be paying customers, it could be signups, so on and so forth. But you want to always ask yourself, what is the next step after I raise money? And do I look at that next step as part of this raise or part of the next phase of the fundraise? Okay. Any questions here? Yes, Jonathan.
My question is, what is validation? How much traction? What is the what does it mean to have validation in here? Yeah. Is that
So validation can be quite a lot of things, and I don't want to teeter too much with like what the pitch deck kind of looks like, etc. But validation, generally speaking, will mean a type of product fit. Somebody's either paying for your product or using your product, right? And that's what we would like to accept as validation. Or people have signed up for the idea of the product can be a sort of validation for an initial funding raise, but that's also part of I want to solve a problem and I want to create an MVP.
So it's not related to how many people are using it. So it's more like just to get the first set of people paying for the product, basically.
Yeah, it can be, but it also can be people using the product, right? So if what is a general token that we use? If people are not paying for the product, they are the product, right? And that is validation itself. Because I mean, Facebook is free, but you are the product. Facebook now values their validation to revenue generated. But when they were first raising funding, it was users. That was their validation. People are using my product, guys. That is my validation. I am solving a problem. Does that make sense?
Yeah.
So for yeah. So I'll pause there. Micah.
Okay, hi, thanks. So my question is based on how much we raise at the MVP stage. Because with my team and I, during building our MVP, we got to a certain point where we realized we needed funds because we couldn't bootstrap anymore. But it wasn't that much that we needed. I mean, to an angel investor, but to us, it was a lot. So we're thinking, in my part of the world, it's usually equity, not safe. And we do not want to give out so much equity for less money. And we do not want to maybe try to raise too much funds for less equity. I don't know if that makes sense. So we're a bit of
It makes complete sense.
Yeah, so we're a bit of a pickle on how much to raise and how much equity we need to give out because we are still at the MVP stage and we don't want to dilute it before we actually launch fully. So yeah.
That's perfect because it leads right into my next slide, which is raising your first dollar, right? Which is how much do you think you're going to need? Which is what is your goal? And why don't we use you as the example? Do you have an MVP already? Or are you building the MVP?
We are building the MVP, about 70% done.
You're 70%. What will it take to get you across the finish line? How much money do you think you're going to need across the finish line and why, right? And I'll pause before you even answer that question because that generally is going to go into development costs, right? And payroll for yourself to make sure that you guys can live. Because a lot of times what people will say is, when do I stop working my day job and move into this at full-time, like a full-time level? People who invest in you want you to be working on what they've invested in all the time. I mean, with work-life balance, but they want that to be your full-time job, right? So what does it take for you to build this? So payroll and staff and development to get you across the finish line. What does, and if that's just your goal, I just need a little bit of money to build out the MVP, and I know people will come, right? That is one strategy to go, you know what? I want to raise a little bit of money at a modest valuation because I only want to give up 5 to 8% of the company at this point in time. So I'll give an example. I only need $10,000, right? And I'm going to value my company at 100, like not 100, but like let's say $100,000 for easy math. I want to give up 10% of my company because I know that if I get this MVP, I'm going to get users, and that will be my validation. And so, as an investor, if I come back to you and go, that sounds great, but from what you've told me, what if I want to give you $15,000? What would you do then? Because that happens a lot. They go, I believe in you, but I think you might need a little bit more money. I will give you more money for more of the pie. What would you say?
I mean, we will take it because we are trying to raise in dollars and our currency at the moment isn't kind of stable. So taking a bit more than we need is a bit safer, I would say.
Okay. And so you just have to balance that because they're not just going to give you more money. They want more of your company. So you can respond back, well, I'll take more money, but I'm going to switch the valuation and bump it up just a little bit only though, right? And you can now see the levers of what you will accept as a company because you think you only need $10,000. This person thinks you need $15,000. right? But he wants more of your company because he might believe in it a lot. And then you can start to see where the leverage you are there in play. And you go, you know what? Why don't I do this? I believe in the company. I will change my valuation cap. I won't change the valuation cap, but what I will, I'm going to change the valuation cap, increase it, but I will give you a bigger discount to protect you just in case there is a bad upside for you.
Okay.
You have levers that you can use now to say, okay, I will change the terms and ensure that maybe I will protect you a little bit more in this way, but I will get more money. And they're just things, and that becomes a negotiation, right? But remember to focus in on the goals and what the result of those goals are going to be. Yes, Ray?
Thank you.
Wait, so what about time? Because I think you should, if you do your homework, right, and you know how much money you're gonna be burning, right, and you ask for, I don't know, $750,000, right, you would also have to have figured it out how much time you're gonna need to reach that goal, right, to have
Yes.
enough runway with the amount of money you're gonna get. Do investors pay attention to this detail? Like, I'm gonna need, I don't know,
100%.
I need that amount of money to have at least 18 months runway so that I can get to my goal? Or because I guess products and services, they all have different kind of, time when it comes to approach those goals, right?
100%. And you, very good to bring that up. I was going to put time in this, but I didn't want to muddy up the waters in here because part of the use of funds will be the time spent and how long it's going to take for you to produce an MVP or reach the goal. I want to really focus on what is the goal and the result going to be from the use of funds. And the use of funds goal, and be ready to defend this because you will be challenged on these. Will you get validation, customers? Ideally, you'll have product market fit because you have customers from that. You will go from pre-revenue because you have customers, go from pre-revenue to revenue. And then because of that, you've built a team to handle the business itself. And at this stage, you are a product-based company. Even if you're doing services, you are a product-based company. And it's very key here because the next step for you, after you reach product market fit, you go from a product-based company to a sales company. All you're doing is selling because your product is done. You want to sell. Okay. But this is the angel round. And your levers now are again going to be your safe notes, your convertible notes, right? And your levers. Your levers are going to be, what is the valuation cap? What is the discount rate? How much money do you want to raise? And how much of your company are you willing to give up? We will also go through in the cap table section how much money you should be aiming to, not you should be aiming, but what you would like to stay within on each level of your each level of your raise. But the focus and the goals of this portion really should be, what is the use of funds and what will the result be of those goals? You remember, you can raise multiple angel rounds. So maybe you say, I only want to give up 5% of the company right now to make sure that I get the MVP out, right? But then the caveat is, what if you don't? What if 3 months in, you don't have the MVP out and you run out of money? Would you not have been better off raising a bit more money, ensuring that, and saying, my MVP will also get me validation, so I want to raise more money there. So just make sure to balance that out and run through the numbers. And I'll have the example cap table where you can run through the numbers in an Excel spreadsheet that you can plug in and know what the dilution is and how much money and how much of the company you're giving up, so on and so forth. Okay?
All right, thanks. I'm no expert, but I think it's really important to take into consideration when you're doing your calculations of
100%.
how much money you want to raise based on how long it would take you, given the amount of money you have to burn monthly, right? But thank you for the answer.
Yeah, of course. Any other questions that we have so far, just in this initial phase, Jonathan?
So I know I know I read about that sometimes it's like people or investors, they don't want the company to become a profit, not profitable, but like they want to always have the company spending, burning and growing really fast rather than focusing on becoming what's it called, cash flow positive. But that, how often that happens? Do we really need to worry about that or not? I mean, have some idea about that area?
it depends on the investment thesis of that person or that VC, right? I think, and I think that what we have seen in the last at least 3 to 5 years is that more venture capital companies are focusing on top dollar, top, like what the company brings in, and is where the vision is on profitability is more important now than just straight top line revenue growth. And it also depends on the investment thesis of a lot of different regions of, and especially in the US. I raised money in the Southeast, and they're very, very focused on how much money can you make quickly by being profitable. In the West Coast is how much money can you make? It's growth and nothing else, right? And it really depends on the investment thesis of the people that you're talking to. And you may also want to look for the companies that have that certain investment thesis that matches the company's trajectory, right? So if your company is a user-based company where your validation comes from user count and monetization of that user count at a later date, you're going to want to look for investment companies have invested in companies that have previously shown that type of investment mechanism, right? Think of companies such as Uber. Invested into Uber, that all they were doing is they were spending investment dollars to gain market share. Or companies that have focused in on companies that really are looking at top line profitability, and so focusing in on those will be the balance that you also create in that sense. Have I answered that question?
Yeah.
Okay. So while going through this, is say you've raised your first $200,000, let's say, right, or whatever dollar value that you're looking for, and you have gained validation, therefore have created some sort of product market fit. You've gone from pre-revenue to revenue, and you've built a team, and you've built a product or service, right? And you've completed your angel round. The next step is you did it. Now you need more money. The question is, where are you, and where do you want to go? Where do you want to be in the future? Meaning, what are you going to use the money for? So what you want to do is you want to start to value what is your monthly recurring. Therefore, what is your annual recurring? What is your churn rate? What is your growth rate per month currently? Where are you right now? When you raise the money, what will it get you? And how do you value that? How do you even know how much money to raise at that next stage, right? Because the first amount of money that you've raised is to build the product. The next set of money that you want to raise at the seed level is going to be, how do I sell the product? How do I get more people onto the product? How do I get more people paying for the product, right? The use of funds will be more likely, instead of just a simple, this is what my use of funds are going to be, is in the pitch deck at a seed level, you're going to be still using this, but more likely the VC or the investor is going to want to look at a proper financial deck with proven numbers, because in your initial ask at the angel round, you said that you have allocated money for sales. Well, how did that sales come about? How did that sales go? You've had sales now. How did that go? And where can, as an investor, I put money into a company to get more money out of the company, not out of the company, but how do I make more money for the company, right? There are very, very many ways to do this. And so for a B2B company, it might be LinkedIn outreach, more salesmen, right? So per salesperson that you have hired, they have generated X amount of revenue. That is something tangible that you can put inside a financial deck to go, if you give me more salespeople, I will make more money because I have these 2 salespeople and I've generated dollar figures per salesperson. And the more money I give you, the more money an investor gives you, the more money that they will generate. For a B2C company, it could be Google AdWords, it could be LinkedIn or not LinkedIn, it could be Instagram, and I'm showing my age now, TikTok, any manner of those. How much money have you put in and how much money have you generated from that, right? And so those are things that you put into a proper financial deck that you for yourself, the financial deck is like 80% for you to know where your money is coming from. Then you can prove to an investor how much money they can put in to generate more revenue. And the use of funds will get the investor over 1 million ARR, preferable, right? You have to make sure you can prove product market fit, and you can prove that you can generate more monthly recurring revenue percentage per month. And how that happens is inside the financial deck. So an example of this will be, okay, guys, we have let's say $30,000 or $20,000 a month in recurring revenue, but that money is coming from Google AdWords, and for every $100 I put in, I have gained an additional $500. Great, cool. I will give you, if you're telling me right now that I can 5x my money by just giving you dollars and you put into Google AdWords, I will give you money because you have proven to me that you can 5x that money, right? But remember this, in the beginning, we've talked about this in the seed round. They're looking to at least 10x their money. How are they going to do that? So you're going to really focus on your sales strategy and figuring out, okay, how can I take the money that they're giving me and in different fashions and ways, right, use that money efficiently to create sales for the company. You have now moved from a product-based company to a sales company. All you're doing now is selling. Obviously, there's going to be development work to enable those sales, and all that can be definitely placed in there. But investors at this stage do not want to hear that, hey, we're still figuring it out. In order for us to figure it out with our technology, I need $1 million. They're not going to give you $1 million to figure it out. They're going to give you $1 million to make more sales. I'll pause there. Any questions so far from here? And as a gut check, Ben, am I hitting the spots kind of like on there in a general sense on the kind of pathway?
Yeah. No major notes. This is great. Thank you for
Okay.
taking the time to lay all this out, Kevin. There's know, there we could talk about this for days and days and days and still not cover all of it. But this is a great overview. Thank you.
Perfect. And so where are you, where do you want to be is kind of the focus on every single step of the way when you're raising money, right? And so where you want to be is you want to be growing monthly recurring revenue, and you want to be growing that to an exponential sense, right? You want to hit, right now you're here, seed round, now you're here. What do you want to hit? You want to hit this. You want to hit this kind of traction with your company growth. And that is why this page is extraordinarily bare, because it really is. Once you get to a Series A, you're going to have a full stack team. You're going to have a CFO. You're going to have a CTO. You're going to have a really robust team of people working underneath you, because the seed round is there to make sure you flush out that team. And the only purpose of that Series A is value the company, get more money in, because you want to hockey stick this, and you want to turn this rocket ship into 3 rocket ships. There's not going to be a lot of questions here because it's relatively straightforward. That Series A money right there is to make sure that you go from, I can't even think of an example at this point in time. You want to go from the guy that went from your garage to a co-working space with a team to, I have now a full team and a full floor of people working for me. And right now, if you give me money, and I've proven that if you give me money, I can 10x your money. That is when you hit a Series A. Any questions here? I know everybody's kind of like, oh, that would be so nice. Trust me, we're going to get to a point on the cap table where you go, that is going to be really nice, until you realize that you've just taken a lot of money from a lot of different people with a lot of different expectations. So, yes, Ray?
I'm sorry that I'm asking too much, but I think it's the best way.
Oh, no, keep going. Yeah.
Now that we are at this stage, right? When do you start protecting yourself as a founder? Like, because more money, more shares, more market, more investors, it's going to drop. You're going to go to the point that you have way less than 50% of your company. How do you protect yourself to keep control?
Ideally, you start protecting yourself immediately. You set inside the covenants of the company at the first inception. And what I will do is, Ben, I think that we will put in an additional webinar, because that can be a full hour length webinar, where like, how do you protect yourself as a founding team, right? From dilution, from being exited out of your own company, right? From getting boards, making sure you always maintain a good amount of board seats, etc. Right? So we'll talk about that later on, Ray. And Ray, you and I can also talk about that as well.
Sure.
But you want to be protecting yourself at the very inception. But remember that every single one of the times that you include something that a Series A investor may okay, so when you get to this stage, and I'm going to be very frank, not a lot of us will get to this stage, right?
Of
But
course.
when you get to this stage, a lot of times you'll hear the words, "We've never done it that way. We've never included this term into this term sheet." I would never. That's not even a question. We would never include this term. If you want
Yeah.
the deal, buddy, you're going to include the term, such as, I want to be able to be. Yep, Ben.
Oh, I didn't mean to cut you off,
Yeah,
Kevin. I
yeah.
apologize. I have to drop.
No, keep
I have
going.
a two
Yeah.
o'clock. You guys, Kevin, I've made you the host. You guys, please keep going. This is great. Keep it up.
Okay.
I will see you
Bye
guys
bye.
later.
Thank you. Thank you so much,
Thanks.
Ben.
Thanks everyone.
And so like they're gonna put in things like, oh, like we'll never include the idea that you can appoint your own additional board members, or you have a term that you always have extra board seats. We'll never do that. But that is how you protect yourself, and we'll include that at a later date.
Right.
But you definitely want to start thinking about those things, because what
Yeah.
is a board there to do, really? A
Yeah.
board is there to remove the CEO if they don't think the CEO is doing a good job.
Thank
So
you, Kevin. I think this
yep.
would be a really good topic for another
Yes.
webinar, but equally important. Equally important, because a lot of people put a lot of importance in this more than 50% ownership in their own companies the whole time. And believe it or not, from what I've seen, sometimes you're never gonna keep this 50%. Okay, you're gonna
Correct.
go way down. And the important
Yep.
thing is to keep yourself, how do you keep yourself from not being voted out of your own company? But that, Kevin, you would take that from me at some
Yeah.
point in the future.
Oh, definitely, yes. And I, just as an aside from just that little brief moment, will be, you know how much Jeff Bezos owns of Amazon right now? 9%. He owns 9% of Amazon, but he is the largest single shareholder of Amazon, so he maintains control.
Right, right. That's the point.
I
Yeah.
want to, yep. 10% of 9% of Amazon is worth more money than likely any of us will ever see. 100% of my company is worth nothing to 9% of Amazon. We have to keep that in mind. So, what is a cap table? A cap table is a company's equity and ownership structure, or simply who owns what or is owed what. And so, by going through the really cool company, what we've done here is we've actually taken a look at the angel ask, sounding dilution, usually $10 million in shares. And for this purpose, we're using an extremely simplified single investor. And because we have valuation cap of 2 million of $10 million in shares, you've technically priced your shares at 20 cents per share. The founders get 80%. Your options pool, which is going to come into the terms of how you're going to set up your business in the future, is 20%. So after the investment, your angels will own 10% of the company. You'll go down to 72% of the company, right? And then the options pool will be diluted down to 18% of the company. I've tried to make this as simple as possible, the dilutions, because the dilutions is a whole number webinar in itself, but this is what it looks like after your angel round. Now you've raised money at the seed round at 1.275. And the reason why I use such a weird number is because sometimes people do not like to see round numbers because they don't think you thought about it. If I say I want $1 million, okay, like why? If you put in an odd number, you thought about that number a little bit. So at the seed ask, at the convertible note stage, this is all prior to a price round. This is what the dilutions will look like, because it's $8 million valuation at $10 million shares. Your shares price per share has gone up now to 80 cents per share. And this is how you start to see your prior investors gain a return on their investment, because the price per share now has gone up. I'm going to let everybody kind of just look at the screen for a second and see how, like, if there's any questions about this, right? Your angels have owned 10%. Your seed round investors now own 16% of the company. And this is before dilution, by the way.
Grab your phones and screenshot it.
Hey, Jonathan. What's up?
The options pool that you're
Mhm.
setting, that initially starts at 20%. So, I mean, I joined late, but is that related to the option, the shares that we will that we will give to the
Your
employees.
employees.
Oh,
Yes, this will be shared reserved with the employees. Your options pool can vary. The later you are that you raise, the less options pool you are technically obligated or want to put into the options pool itself, because there's less incentive. Like there's no, the reason why those option pools exist is you want people to be incentivized to work for you, because there's inherently a danger to work for at a startup, because a startup can go belly up at any time, right? So you have a share kicker to go, look, if you work for this company for the next 2 years, you get 1% of the company, right? And so that's kind of what you reserve the options pool there to be. If you do not use the entire options pool, you can also have, and this is going to be part of the negotiations as part of like what you do as a founder, your founding documents, that you can reserve the right to absorb the options pool back into the company itself.
yeah, that's what I
Okay.
was thinking. Yeah, I mean,
Mhm.
for how long will you provide that option to or that incentive to new employees? Because it's like say after
Doesn't,
2 years, right? So after
yeah.
2 years, you went out and you are, building all these. So,
Apple still has options pools.
oh, really?
Yes.
Oh,
You will gain certain shares of the Apple stock as part of your incentive to go work for Apple. Yeah.
mm,
So just an idea again. Obviously, at that point, Apple's options pool is they have a setup. They probably still maintain like a 20% options pool, but now it's divided by all these different employees, right? But it's the options pool is also a way for you to entice high value workers to come to your company. So if I need a CTO, I'm gonna take money out of that options pool and go, hey, you CTO, you're gonna get 5% of my company, right? It's an enticement for employees to get in there. And this is what a cap table kind of looks like. But I've also included a link to a simple cap table that you guys can actually fill in and use for yourself in this presentation as well. You can just click on it and use it. Okay, just make sure to copy it and move it into your own Google Drive. It's a Google Drive spreadsheet. Cool. And finally, I'm gonna have the strategies as questions that kind of encompasses all of this. How much should I retain at an angel and seed round? There are obviously preferences, but it is generally accepted that you do not want to sell more than 20% per funding round. I use Jeff Bezos as an example of Apple, but his first funding round was $1 million at a $5 million valuation cap. He gave up 20% of Amazon at his first funding round to build Amazon. So he followed the exact timeline right there, 20% of the company of that time. But again, if you think you're going to need more than one angel round, you want to split that funding round up, right? I want to give up 10% now, 10% later. So you just want to make sure you play around with those numbers and be aware that there can be things as down rounds where your company is valued less and you get diluted more, but you want to be selling no more than 20% per funding round. Okay. How do you set a valuation cap? How much of the company do you want to retain? And how much capital do you need? That is the balance there, right? And so that balance is how you set the valuation cap. And so setting the valuation cap can be too high or too low. The valuation cap is your major lever that you can use to kind of alter the balance of an investor or an investment. So Ben's no longer on the call, but if you go to Ben and you say, I have an idea, but my valuation cap is $10 million, he's going to hang up immediately. He won't. He's very, very nice, right? He'll still hear you out, but he's probably going to tell you, hey, at that valuation cap, I'm out because the risk is too high and the upside is too low for me, right? And then at that point you have to go back and revisit yourself and go, am I cutting my investors, the potential investors, a good deal or not, right? Because you can always set the valuation cap too low and give up too much of your company, and that can be a red flag for an investor. Okay, so say I go out for funding right now and I go, I'm going to set my valuation cap at $3 million, and I've already raised before, but I'm willing to give up 33% of my company. Why am I giving up so much of the company? Am I in danger of losing control of the company? Because believe it or not, the investors at an early stage want you to be incentivized to work on the company. So an example of this would be, what if I get to my Series A round and I already only own 10% of the company? that's a big red flag for an investor because, okay, so say you stop working, like you have no incentive to work in the company now because you only own 10% of the company. Why would I invest in you when the founder is not incentivized to work for the company? So those are the different balances you want to think about when you're raising funding for the company and your valuation caps. Also, if you're raising money and you set your valuation cap at a good rate at 20% per funding round, right? I'll get right to you, Jonathan. 20% per funding round, right? And all of a sudden you have 100 investors that want to come in and join the round. You can now begin to pick for investor competition and go, why should I let you invest in my company? That is when you start hearing the words oversubscribed. That means there are more people that want to invest in the company than the amount that you want for the company at a certain valuation cap. Be very careful though. If you have currently already opened up the round at a certain valuation cap, but you have oversubscribed to it, this is when there is a bidding war. And you can now go back and go, I've raised my valuation cap from 3 million to 4 million because of all the interest, and see what investors drop out. This is very dangerous though, because a lot of investors can drop out and all of a sudden you've gone from I have a lot of leverage to I have no leverage, and you got to go back now. So just be very careful there. But investor competition is always the greatest and highest amount of leverage you can use for during your thought process on a valuation cap. First Jonathan, then Ray. John?
So then at the very beginning, when we are starting, when we need to come up with the first valuation caps for the very first rounds that we are going for, we should, we should do it the opposite way, in the sense of like, I will look for how much money do I need to achieve this goal, and then convert that into between 15 to 20% values, so then I can get the actual valuation gap. So in other words, it will be like say, like, I'm gonna make it simple as like there's what, like I need $50,000, and so if I need $50,000 for my first round, then it will be like what not sorry, what is 20% $50,000 over 20, what is 20% that matches
we get the point that you're going with, but it can be like that. That's one strategy of going forward, because it gives a lot of meat on the bone for the investor to kind of grab onto if they believe that, right? But it also gives you a good amount of control still inside the company. However, what if you said I want $50,000 and you wanted to ensure that you own still 10% of the company, right? And so you just have to play around. You just have to play around with that, during that. Does that make sense? Like, so if you need $50,000, right, you may not opt to value the company only at like the like, not even you're not reaching a large amount there. So just keep that in mind when you're making that balance. Is, do you really only need $50,000, right? Maybe it'd be more worth it for you to raise $100,000 if that money is there and available, because you can get more done with that money. Okay, so it's both. You want to look at it backwards, but also forwards. But the way that you're looking at it is the correct way that you want to start looking at how much you want to raise. What do I need? How do I get there? And then, do people believe in me enough to give me the amount of money for me to raise that money?
Yeah, I mean, for me, it's like the hard thing for me is like how you come up with the first valuation cap, right? And it seems that it's much easier when you already have traction, you already have people paying for the thing that you need, and it seems like it's easier.
So remember the valuation, and we've talked about this during the pitch deck presentation stuff, which is, if you've got traction, and traction can mean a lot of different things. But again, if you need the money to gain traction, you can do so. Just set a good valuation cap have very clear, crystal clear goals that you want to keep in mind, right? And then kind of go from there and see what bites. Remember, it's not all funding rounds succeed. I failed at my last funding round. So yes, Ray.
So you shouldn't only cap your valuation, from what I understood, but you also need to cap your early dilution, right?
Yeah, I mean that goes part and parcel with the valuation cap and the amount of money raised. That goes hand in hand, right? And so
Yeah,
you just want to make sure that you want to raise as much money and give up as little as a company as you can
right,
as a founder, right? And
right.
that's kind of the goal. They go back to Jonathan. I didn't ask you if I answered the question, but like that's the balance is how do I retain as much of the company as I can while getting as much money as I can, right? To
Mhm.
build and achieve the goals that I need for the company. Okay.
Right, right, right.
And those are the balances there. And keep in mind that I also have your strategic investors. Um, 3 of my largest investors are my clients
Okay,
because they're strategic. And I've given them good valuations in the company because I know that they can bring more value to the company. So you want to start looking for those as well.
right. They want you
And
to
so
succeed as well because they're your clients.
exactly.
They kind of
Yep.
supporting the early stage of the startup. Yeah, all right. That makes sense.
Exactly.
That makes sense.
And so you can definitely raise multiple seed rounds, but you definitely want to end up with over 50% ownership after the seed rounds are done because you want to hit Series A because after Series A, you're going below 50%.
Right. Yeah.
Very rarely are you going to hit a Series A round, right? And still maintain more than 50% of the company.
Right. Yeah, that makes
Okay.
sense. Thanks.
And then remember this, guys. I know the whole point of this is like raising money and raise phases and stuff like that too. Choose the time that you want to raise money carefully. The second you raise money, you owe people something. You are beholden to them to make sure that you do your job as a founder so that the company succeeds. Okay? I know that everybody in here is very, very excited to raise money because it's like, that's why I say don't raise money for the sake of raising money. Raise money because you want to solve a problem and you want to achieve a goal. They're very different mindset. In the beginning, and that's the mistake I actually made during my last funding raise. I was like, I think I need $1.4 million because I can definitely make money on that because I want to get paid. Not the right mindset. People can see through that instantly. And then once you raise that money, they expect things out of you. They expect you to get a Series A within 1 to 2 years. They will put pressure on you to get to Series A within 1 to 2 years. They will put extraordinary pressure on there to get that because they have pressure behind them, people who invested in them to make sure they get a return on investment. Okay. Now, if you get to the seed round and they want board seats, guess what they're looking to do if you don't reach Series A in 1 to 2 years? They're looking to replace you so that they can find somebody who will get that. Be aware that once you have raised that money, the VC treadmill is difficult and is very hard to get off that VC treadmill because now you are constantly beholden to your venture capital companies, the people who believe in you to make sure that you succeed. I'm going to pause there. What questions does everybody have? Because I know I've gone way over time at this point, but I think that this was not an easy webinar to make concise. But what questions does everybody have? I think we've covered a lot of things in a very short amount of time. Yes, Andrew?
Let me know if this is too far off track for this particular talk. But one thing I've been seriously considering is crowdfunding because in the industry I'm kind of in, it's pretty common for people to do that, and I think it's also less common for super big investors to come in and invest in these kinds of companies. So I mean, like assuming you're successful post crowdfunding, where would you fall like on that the pre-seed seed? Yeah, this here, like
You're
where would you like
you're
where would you fall in it?
yeah. really the thanks, Dr. Lori. There's so much stuff that we covered here. I'm afraid I went over time. But for a crowdfund, a lot of times, it depends on where you're crowdfunding from. Are you going through a platform, or are you going through literally like what is the Kickstarter, etc. Right? Because those two are very different types of platforms. One, they're receiving your product, not shares of companies. So I'll focus in on the crowdfunding platforms that we see out there, right? And they generally fall into the seed round here, because the crowdfund works as one investor. The crowdfunders are investing into the vehicle of the crowdfund, and they look like one investor on your cap table. Okay. And so that crowdfund itself is very strategic in several ways. The crowdfund can be seen as free market, not free. This can be seen as marketing for your product or service, right? And that's what a lot of companies use the crowdfund for, is to go, look, we've opened it up. Here's your chance to own a small slice of this company. And that can be very exciting. It's newsworthy. You put it everywhere, and that's kind of where the crowdfund comes from, right? And so the expectation is, again, they're going to be looking at what are your goals and how you're going to achieve them, and what money are you going to use to achieve that goal. But the crowdfund itself can be seen as traction if you don't have any funding or you don't have any customers. It can be seen as traction, right? But so I've never seen it go into the venture round, but I've seen it in the seed round, and I've also seen it in the angel round, right? But never in the venture round. So angel and seed. If you use it as your first funding source, it is your angel round. And you can actually use it as a mechanism to tell your friends and family without much pressure. Hey, if you want to invest in me, here's the method of which to do so. And then the crowdfunding platform will do the work for you. Does that answer your question?
Perfectly. Thank you.
Perfect. Any other questions here? And by the way, if you want to break off into small stuff, so the presentation itself is done. So if anybody wants to stay on, I'll stay on for another 10 minutes, right? To kind of answer more kind of small questions, or if anybody has specific questions about their company and their fundraiser they want to talk about, please go do so and ask now. But if not, thank you everybody for coming. I know this is a long presentation, it's an hour and a half. But again, thank you everybody for coming. Dual?
Hey, Kevin, thank you for the
Hey.
amazing presentation. I definitely learned a lot and just very detailed and thorough. My question, right? If you're like, I'm looking to start my first round, Angel, either through friends and family. I've had some people who mentioned interest, so this has just been invaluable to me. My question is, what about non-equity ones? I know one person who I was speaking with, they brought up the shadow or phantom shares, other things like that, and debt to equity. I guess would that be considered one of the rounds, or if there's any more details that you would want to be able to give on that?
Yeah, so I would recommend, if you can, to not do debt, like equity debt just yet in the initial, because that can look very heavy on a cap table, right? You don't want to go out for your next funding round showing that you have a lot of debt. Because then what is going to happen is they're going to say, look, you have a lot of debt. Is my money just going to go to debt, not sales? They want you to sell. They don't want to pay off your debt, right? So equity debt is heavy on a cap table. Not saying that it can't be done, but that's generally done in a more, we'll say, I need money quick and I need money now because the company may not be doing as well as I thought. So it's irregular to see that in the initial stages. Okay. You want to make sure that the message you bring across with your round is that people believe in me. They're not here to make a quick buck. Does that make sense? So think about the mechanism of which you're raising that funding and what that portrays to future funds when you're raising future money.
Perfect. I appreciate that insight. So something
Yeah.
more on the lines where it'd be like phantom shares, not getting into debt, but just more of, I think one of the ones that you mentioned before would be like a strategic partnership. It's like, hey, work for me for 2 years and you'll get 1 or 2%.
What?
Be an advisor and get 2 or 3%,
There we go.
but just
Advisor
have those
shares. Yep.
people. Yep, just have those people who have the experience, have those
Hmm.
connections, be a part of the actual founding team. It would just be
Yes.
smaller equity, but they would be bringing in their connections, knowledge, and experience.
That would be a part of your pitch deck, actually. If you have advisors that are very key, that offer strategic insight, you can definitely give them advisory shares that vest over a period of time. Um, I will also include into this, I'll edit this presentation to include sample advisory share contracts. There are three types. There's like the shadow ones that are just like, I'm gonna give you, they technically should be hourly rated, right? Because like they can say, I'll give you like 3 hours of my time a week. And in return, because I believe in you and I like you, but I'm really busy, and and my company does like $100 million in ARR. So like my name on your pitch deck is going to look really good, and I just want some portion of the company. Generally speaking, you're looking at a vesting share base of like 0.2%. It's not high. It's very, very much, hey, thank you. Here's some shares. Thank you very much. You know, and that's kind of what we look at that with. So those are looking at advisory shares. Thank you, Fabio. Xavier?
Yeah, thank you, Kevin. This has been very, very Shackles inspiring, Shackles educating. So I just have one question. I get asked should I say every few days when I'm speaking with investors here in Nigeria, and they ask, how do we get our money back? Now, obviously, I know they get their money when they make their exits, but how does that actually play out, like for angels? How does it happen? Do they like sell their shares to other investors? How do they convert that to, let's say, their
Sure.
money back?
So we'll look at the cap table here. Good question. Andrew, sorry, Andrew, I just like skipped right past you. Did I answer the question about shadow? It's my first webinar, so I'm still getting the hang of it. About the shadow investors, etc. I wanted to make sure I wrap that portion up. Or if not, you can just also give me a thumbs up.
I think you said my name, but I wasn't the one who asked.
Oh, sorry. Who asked about the shadow? Was it Dual?
Yeah, that was me who asked. It
Yep.
was phantom shares, not like more of a
Yep.
phantom shares or like a strategic advisor, and kind of seeing how you would incorporate them. For my information on phantom shares, it would be that they would have shares in the company with their investment, but they weren't have any equity or ownership. So once they want to cash out or you want to pay them out their
Like a
shares that
cash
they did.
bonus.
Yeah, something like that.
It's
So then they would get the interest rates, or you would, just pay them out the growth that they helped you from their investment.
it's not common. It really is not very common to have phantom shares. I don't even know how that would be shown on a cap table, honestly. I think that would be shown as just liability. I've never seen phantom shares on a cap table. That's just me personally, though. I've never seen phantom shares on a cap table. So I wouldn't have as much knowledge about that. So I apologize about that. But I will do some more research and get back to you on that to see if I can find an example of a phantom share contract and what that looks like on a cap table. Sound fair?
That's great. Thank you, Kevin.
No problem. So to kind of further answer the last question would be, how does the angel exit? Right? It is when the price round happens, and everybody exits when you sell the company. That's what it comes down to. They want you to either sell the company, or they want you to IPO, or they want you, and maybe you've built a giant company and that's doing really well. During the Series A investment process, there will be a clause in there that the owners get a dividend. And so a lot of times what you'll see inside a Series A investment clause will be that when you take a dividend, the investors will also have a dividend issue, that you cannot issue just yourself a dividend. Does that make sense? That's how they get a return on their investment. More likely than not, they will get the return on shares when you sell the company. Example here, would be the angels have 10% of your company. Yeah, there are dilutions as things go around, and let's just assume, but after dilution happens, you have the angels have 5% of $100 million company. That is how they get the return on the investments. When you sell, they get 5% of that. Yeah, Savior?
So I'm curious, is there no situation where probably for some reason, right, they are not waiting till you sell your company, let's say probably 4 years, 5 years in, don't like make an exit? I mean, that's what I'm actually curious about. I know about the selling company part, but if you don't want to make an exit early, don't want to cash out early, how do they like convert that shares into actual cash?
They don't.
Without going to the dividends.
They do not.
I see. All right. Thank you.
Yep. So that's why angel investing is inherently very risky, because most startups fail. Number two, if the startup doesn't need any more cash, they don't convert. Guess what happens to the person that invested in you? Obviously, when you sell, you have to give them the money back, right? But you've just kind of screwed them, right? So that's why angel investing is inherently extremely risky. But also remember this, guys, they know the risk. People who are angel investors, they know the risk. They just like what you see in a lot of trading platforms and like stocks, investments are inherently risky. You should be prepared to lose that money. So even when friends and family invest, I tell them very clearly, hey guys, this company may fail. I want you to be aware of that. Just so you ensure that you're very, very honest with them. So anything else?
No, that's all. That makes perfect sense. Thank you.
I got you. My pleasure. Well, if there's nothing else, guys, ping me if you have specific questions about your company. I'm very happy to look at your raises, what you're going to do. And this goes to like what I would like to do with like with people in the future, which is like pitch to me. I will give you honest feedback on the pitch itself and the reactions I will have, and the questions that a general investor is going to ask you when you do your pitching, which is going to be, I mean, I've experienced. Generally, thankfully, what I've experienced when I've pitched is that people either like the valuation or they don't like the valuation and just tell you, and you don't negotiate against yourself. And so when it comes down to it, be prepared for, be prepared for hard questions. You want to be able to defend your assertions during the pitch, and then be prepared to say people to say, look, I don't think your company valuation cap is going to be a good deal for me. Be prepared for that kind of stuff.
I would
All
definitely
right.
come to you. That's for sure.
Thank you. Thank you. I hope this was helpful for a lot of people. I know that
It
this is
was.
very long. Thank you, everybody, for coming. And hopefully the recording makes my voice sound better. Thank you,
Bye-bye.
everybody.